25 is a micro double bottom and a bull bar closing on its high. So similarly with bar 21, I would not buy above 25, although some traders will, and it's not all that unreasonable. After consecutive sell climaxes, you're far from the moving average. The market's likely to pull back. Always in bears, probably exit shorts above bar 25, and aggressive bulls will buy. And this is a great example of something I've been working on, and give me just a moment, I'll pull it up. I came up with this just as, it's kind of a joke, just for a way for me to remember it. GTFO, it's kind of a default exit, is exactly what it sounds like. And if you just read here, this is the type of situation we have here. This is why I'm bringing it up. So when the market's far below the moving average, in this case, it's racing far from the EMA, and you get a strong opposite signal bar, the market does not always need a second reversal to get a very deep pullback or to even reverse. And the more of these characteristics are present, the better, in my opinion, the better it is to exit above a bar like this. And I'll go back to the charts in just a moment. But these characteristics are important. When you have climactic or parabolic behavior, it's unsustainable, especially when it's a late leg. Maybe it's late in a trend, maybe it's leg 3, a wedge. When there's 6 or more consecutive bars in a micro channel, that's climactic. Trading range price action to the left, or mostly a trading range day. Trend bars that are getting bad follow through. The bars are increasing in size, which is parabolic. Again, far from the EMA, which means, or let me back up, far from the EMA. So you're far, in this case, far below the average price, and the risk is big. So let's go back to TradeStation. If you're selling here, where is your stop? Where's a logical place for a stop? Maybe in theory it's above bar 19, but no one's going to risk all the way up here, and that's the problem. The problem is the risk reward. You have consecutive sell climaxes, your risk is all the way up here, so 1 times your risk is all the way down here, and you know the market is likely to pull back after consecutive sell climaxes. This is parabolic behavior. It's unsustainable. We're far below the average price. We're starting to go sideways. Inside bar 21, in the past 4 or 5 bars have a lot of overlap. So this is a possible 1 bar final flag, this inside bar, and it's actually a pair of inside bars, 21, 22. This was a possible final flag as well, but this more likely to be a measuring gap, this more likely to be exhaustion. So why am I bringing all this up? Bar 25, for me, has become a default exit. And if you've ever listened to Al, he talks about this too. And of course, he doesn't talk about it. He doesn't call it what I call it. But we're talking about the same thing. You'll hear Al in the trading room, in the webinar, if you've ever listened to him when he's trading. Maybe he's short here, but he'll be saying, if we get a bull bar closing above its midpoint, I'll just get out. And that would be a bar like 25. That's a default exit. And that's sort of for all the reasons I mentioned here. So I have a couple of examples, especially for the bear case, because today's example was a sell-off. So I'll just go through a couple of slides. The market's selling off with a lot of bear bars, but the bars are getting bigger. Might be leg 3. You get a bull bar closing above its midpoint. Usually better to just get out. Same thing here. Usually better to just get out. Lots of these characteristics. And so today was an example of this GTFO exit, as I call it. You can see it's climactic behavior, consecutive sell climaxes. We have, how many bars? This entire sell-off was a micro channel, 15 or 16 bars. That's very unusual. And if we look at the 15-minute chart, we zoom out. Here's the sell-off, but look to the left. Does this look like a strong bear trend? Of course not. Overall, the market is sideways. We go up, we go down, big up, big down, and this might be leg one, pullback, leg two, possible second leg trap to a buy zone support in a trading range. So a lot of those characteristics, trend bars with bad follow through. Here's a trend bar and then a bear bar with a big tail, trend bar, bear bar, big tail, dojis, big bars, but now might be 2 or 3 legs down, very far from the EMA, and bad follow through. Your risk is big. Realistically, if you're a bear, where do you put your stop? There's a lot of problems with this sell-off. So all of this to say, I think it's reasonable for bears to exit above 25, and aggressive bulls will buy. It's not the craziest thing in the world to buy bar 25. Then decent entry bar, and you're getting good follow through. Now, if you're a bear and you're short, you did not exit, at some point you have to conclude the market is going higher, and you need some kind of way to exit. So maybe that's something similar to what I discussed. Maybe that's you get 2 or 3, maybe 4 consecutive closes against you. But the problem in this case here is if you're short, anywhere, I don't care if you sold the high tick or the low tick, it's usually better to get out before you get all of this against you. This is a pretty dramatic move against you. So even if you sold up here and you had an open profit all the way down here, and then all of a sudden 3 bars later, 4 bars later, you've given a lot back. It's just not ideal.